It's worse than I thought. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Doomsday is finally here, and I want to show you why I think it's going to be worse than the global financial crisis. Now, you may recall that GFC kicked off after a string of interest rate hikes caused adjustable rate mortgages to reprice, and then payments went up. And of course, we know that borrowers in a slowing economy couldn't afford those higher payments, which led to a string of delinquencies and eventually defaults, which roiled the entire housing market and the mortgage space. But this time, we're seeing some problems in the residential space, which isn't the same, but still showing there's cracks. But the real problem? Well, if you're wondering why we're filming from downtown Atlanta today, it's because this could be the beginning of where Doomsday is. Now let's head over where we picked today's story up to the U.S. NAHB Housing Market Index. Now this is the National Association of Home Builders. This data came out yesterday, so I want to go a step back before we get into our story today, because I want you to see that home builders are optimistic, and they survey around 900 home builders, and when you get a signal above 50, it indicates they're optimistic. Now, what does that mean? Well, it means they're making money and they see the signs, the dollar signs in their future, that there's demand. In fact, there's more demand than there is supply. And when you're a builder or you're in sales of any kind, that's great business because it means you can effortlessly raise your price and people will be eager to pay for it because, again, demand is outpacing supply here. And you can see in this chart that it's coming off some lows that were set back during the pandemic. It's still higher than it was, of course, during the global financial crisis and even back in the early 90s. But nevertheless, you're seeing this move higher in sentiment. And of course, that should be a good sign for the economy because real estate is a real key portion. As long as real estate's expanding and new homes are being bought, well, the economy tends to grow with it. But there's some problems here under the surface. Let's take a look. Because homeowners don't want to sell, so home builders are booming. And that's the story here of why you see sentiment for home builders up. Let's take a look. As millions of American homeowners have been reluctant to sell because they can't afford to give up the low mortgage rates they have now. Only 1.08 million existing homes were for sale or under contract at the end of the May, the lowest level for that month in the National Association of Realtors data going back to 1999. So this all starts to feed in to why there's this optimism for the housing market, which then turns into optimism for the economy. And many people keep asking, well, why are stocks going up if there's some bad news? Well, the real estate market has a lot to do with that, and I'll show you in a moment. And a lot of the people I'm talking to about their homes, they say the same thing. I'd like to move, but I'm not willing to give up my 3% mortgage, not least no time soon. So far, the home building revival, coupled with financial incentives offered by builders, is providing only minor relief to prospective buyers. Builders aren't erecting enough homes to offset the shortage of existing ones on the market, meaning buyers in many places still face bidding wars, again, causing sentiment for home builders to go up. And on a national basis, home prices have only declined a small amount from their record highs in spring of 2022, even though interest rates have risen to their highest level this year, at least for new homes. So everything's kind of set up to say that perhaps the housing market should be coming down, but again, due to perhaps a controlling of bringing on new supply, slower than there is enough for the demand, you see that everything perhaps looks good, and this will drive the economy. But there's some things that we see today that don't make a whole lot of sense, because when we get to eventually the story of why we're in Atlanta, and you'll see where the real problems are at, you can see how it's going to backflow into the residential space. But one thing that doesn't add up, we got today the Mortgage Bankers Association Purchase Index, and this is an index that tells you kind of the direction of where new mortgages are coming from, and you can see it's on a steady decline. So if there's this huge demand for homes, what we should be seeing is, of course, this going up, but the supply is not there. So there's an issue here. We're not seeing a big demand for mortgages when at current rates, well, what are we seeing? They're not paying for cash. So there's got to be something else going on underneath here. So now let's turn over to Bloomberg, where we see U.S. housing starts fell in June after surging the prior month. And this is where we start to see some cracks in the system here, perhaps suggesting that maybe things in the new home market are not as rosy as the builders are suggesting. Residential starts fell by 8% last month. Almost no reason for it, because here we are during a time of the year that weather is conducive of building, to a 1.43 million annualized rate. The median estimate, of course, was for even more than that. Now, applications to build a proxy for future construction slipped 3.7% to an annualized pace of 1.44 million units. However, this is a good news. Permits to build one-family homes increased to a one-year high. So what we're seeing is, and if you're in the rental space, if you're renting an apartment or looking at them, you know there's a ton of them. They've built a whole bunch of these things, and they're still building more, and more coming to completion. So in a sense, we don't need more apartment space, but we generally do need more new homes. At least that's what the builders are saying. The retrenchment in groundbreakings follows a surprise jump in the prior month and paints more of a picture of stabilization in residential construction than renewed weakness. Even with the decline, home starts are running at a pace that is above pre-pandemic level, and that's good news. But one of the things that I'm concerned about, and you saw this in yesterday's show, what did we hear about households in June? If you recall, they said it was the first month they started to struggle to pay their bills. So you kind of wonder how many people are going to start shopping for a home if they're already struggling to pay their bills today. And if we continue to see an uptick in unemployment claims, and we'll talk about that tomorrow when we get the data, well, it suggests the housing market could be the next to go. And here we can see why the housing market's so critical. If you're kind of wondering what drives the stock market right now, maybe it's because the housing market is following suit. You'll notice that in trends where the housing, this is new starts, is rising, well, generally you see the economy and the stock market rising with it. You see starts start to slow down. The stock market tends to follow with it. And of course, we saw that during the global financial crisis. We see it during the pandemic. And we're seeing signs of it now. The housing starts were down. They're turning around. And of course, the stock market is a leading indicator of that, suggesting that, hey, all the business done from people buying new homes, getting mortgages, buying furniture, moving, and all of the economic prosperity is created by the housing market will eventually filter into the broad economy, unless we're almost at the end. Despite the steadiness in demand, uncertainty over the path of Federal Reserve policy and the ensuing impact on interest rates has led to continued caution around residential construction. The central bank is widely expected to resume borrowing costs next week. So here's the issue here. They're talking about interest rates, and I don't buy for a second that it has anything to do with interest rates. Now, to a degree, I will agree that there are people that are price sensitive on that, and they can't make the hurdle. But if the economy was indeed booming, as we're being told by policymakers all around the world, economists, officials, you name it, everyone's saying the economy is booming, there's plenty of jobs, you can change jobs, get a higher wage, prosperity is yours to take right now. If that was the case, then the people could afford higher interest rates, because they would simply say, hey, you know what? I believe that my business is going to grow a lot, or my wages are going to grow a bunch, and inflation is going to come down, and I can afford these higher rates. But perhaps the real issue in the housing market isn't one that the builders are paying attention to. It's not interest rates. It's the fact that perhaps banks are going to stop lending. And here we can see new privately owned housing starts. Now, we're using the net percentage of domestic banks tightening standards for commercial industrial loans. And I realize it's not the right data series, but the data series on new homes doesn't go back very far. So, and they're very similar. If we put them, overlay them on a chart, you'll see when they tighten for one, they're generally tightening for the other. But I want to look at this because we can see with this data here that when banks on net start to tighten lending standards, what happens, you see in housing starts, it can still rally, but then it starts to come down here a bit. You'll see that going into the global financial crisis. You see banks are tightening lending standards. At that point, housing starts had already started to decline, and now we're seeing it again. So the issue may not just be a function of interest rates. It may be an issue where people want to buy a home, but they can't get a loan, and that will cause major problems for the housing market, because the question is, can we expect banks to continue to tighten lending standards? Well, if the Fed hikes next week, you sure bet we can. And some other indications that perhaps this 1 month of increase from the prior month is going to be continued by a downtrend. Here we can see building permits in blue, a great leading indicator of privately owned housing starts in green, suggesting that perhaps this may just be a slight abbreviation in the data as it continues an eventual downward decline. But one of the other issues here is we see employment shown in blue against new housing starts and housing completion remains rather high. And this is interesting because we see that in the factory sector here too, where everybody believes the economy is just going to hit this kind of soft landing. The ball's just going to bounce a little bit, compress a bit, and go shooting off. And nobody wants to really lay off too many people. The question will become is when we start to see the layoffs hit the housing market, well, that's when we know the whole thing is done. But how about the real issue, the one that I think is causing doomsday to hit? Let's turn over here to this headline: CRE, commercial real estate nightmare for commercial mortgage-backed securities holders as office mortgage delinquency rates suffers the biggest 6-month spike ever. And one thing that should be spiking is your trading account, because if you followed that soybean trade that our CTA-Timer Pro subscribers knew about, well, they bought in down here, and what we look at is machine positioning, and I'll show you, it was telling us the machines were massively short on soybeans. And as soon as it flipped, that's what I've told the subscribers: when you see a flip, take a position, throw a stop loss under there. If it rallies, build into it. And look at this, it gapped up in early trading today, signaling now over a 15% return. It's could have paid for your subscription for a year. Here you can see, looking at June 8th was max short, and there it was on June 9th. The fast algorithms, the one that look at a shorter look back window, they started to trigger, and eventually the slow ones followed. The price is $30 a month. You can see the thing will pay for itself. It gives you some great trade setups. Link in the description below, because now when we start to talk about doomsday, this is where commercial real estate is a big problem, because the banks, they can't handle any sort of problems. After blowing through the pandemic with no more than a squiggle, the delinquency rate of commercial mortgage-backed securities backed by office properties jumped to 4.5% by loan balance in June, up from 1.6% just 6 months ago, according to TREP. Office mortgages have been packaged into commercial mortgage-backed securities went through a horrendous default cycle following the financial crisis, with the delinquency rate topping out over 10% during 2012 and 13. And here you can see on this chart, when we go back and look at the net percentage of domestic banks tightening lending standards for commercial industrial loans to firms of all sizes, and you look at the delinquency rate, well, it makes sense. You generally see, as banks tighten lending standards, and this isn't always the case, you see it going into the global financial crisis, it went the other way, but generally as banks tighten lending standards, what you see is delinquencies follow, and you're seeing that now. And part of the reason is, again, we go back to this analogy of musical chairs. There's only so much money in the system, and when you really have a big inflation of prices and you curtail the money growth, at some point you start to see the music stop and there aren't enough chairs, and that's where you see people that have all this debt run into delinquency, because some people can get the money, but not everyone. And the longer the banks curtail their lending, well, you keep hearing the music stop, stop, and stop, because there's fewer and fewer chairs. And so it makes perfect sense that we would start to see delinquency rates rise here. And notably, when you look at the yield curve, it suggests, of course, even if the Fed doesn't hike next week, which I say they're more likely to because they've been talking about raising rates, it suggests they're going to further invert the curve, and banks are going to continue to tighten lending standards, means they're going to originate fewer and fewer loans, which creates less and less money in the economy, setting the stage for what's going to be a massive collapse, much like the global financial crisis, but potentially only worse. Now here's a chart from Wolf Street, who sourced the data from TREP, showing the percentage of delinquent office mortgages is skyrocketing now to around 4.5%. This is highly unusual, and you see the trend of this, and we asked the reason why. Well, maybe part of the problem is in Baltimore, but the real problem, we'll get to that in a moment, is in Atlanta, and I want you to see this. Because look at this, beginning of the CRE fire sale, as Baltimore office tower dumped at a massive 63% discount. Now keep in mind, when banks lend against properties, and this is something I really want you to understand, commercial real estate is generally believed to never go down in price. Now it did during the global financial crisis, which is considered an anomaly, but in all general views, when they originate these loans, the view is the value of the property doesn't go down. And a 63% hit, well, that's huge, as occupancy drives value and many buildings downtown are struggling to maintain that occupancy. The latest fire sale could indicate more panic selling is ahead, which would depress prices and put banks in big problems as these loans come due. And some argue remote or hybrid work has forced a downward shift in office demand, but that's not entirely the case. Well, not at least in crime-ridden Baltimore. The depressed office building demand is a vote of confidence. The Democrats in City Hall have failed to enforce law and an order as progressive policies backfire. But according to one economics professor, if office space goes vacant and property values plunge, the city could see a massive reduction in property and income tax revenue, which I have noted in the past. During the next recession, you're going to see a push to end remote work and put people back into seats in office buildings because they need these buildings occupied, because they need the tax revenue. I'm telling you, and all the businesses surrounding these buildings need business, need people there. There's going to be a push for it. I know many of you said, no way will I ever go back to the office. I'm just telling you, wait and see. You're going to see that push, because now as we head over to Atlanta, where we're filming today's show, what we can see is perhaps this is beginning of Doomsday. As Starwood defaults on $212.5 million Atlanta office mortgage. Now, you just saw that, of course, buildings in Baltimore are going down in value, so we can only expect that more of this is going to happen. The mortgage on Tower Place 100 in the Georgia Capital's Buckhead District matured on July 9th, and Starwood failed to refinance or pay off the debt. Borrower confirmed they're unable to pay off the loan at maturity, and said the lenders have hired counsel under a negotiated agreement because the banks can't afford to take the loss. That's the problem. That's the biggest problem right now that we face going forward, is when we have the next financial crisis, it's going to be centered in commercial real estate. No one believes the Fed's going to go back to zero. They're going to do it like that just in a snap when they realize that all of these banks that are holding these commercial real estate mortgages have a problem as values are written down, and as borrowers say, why would I pay off this mortgage? Look at the building over there. They just sold it for 63% less. I'll just take this one and you can have it back, and there's a reason why. Corporate landlords, including Blackstone and Brookfield Asset Management, have stopped making payments on office buildings. They've deemed to be money losing as vacancies increase with the growing acceptance of remote work. In addition, borrowers' financing costs have soared as the Federal Reserve have hiked rates, so they have a double whammy. Property values have declined, buildings aren't busy, they're not full, and interest rates, of course, are up. Delinquency rate for offices with commercial mortgage-backed securities swelled to 4.5% in June, as we just covered from that report by TREP. But get this, most commercial mortgage-backed security financing is non-recourse, which means owners can walk away from properties without exposing themselves to further financial damages. So imagine that. Here you have all of these buildings. You're starting to see some of them transact at extremely low values. You have all this debt coming due over the next couple of years, and look at that. What you find out now is a lot of these loans are structured as non-recourse, meaning that if they default, the banks can't come after them. All the banks can do is hope to renegotiate somehow, some way, write down the mortgage on it, which they cannot afford to do. So as more and more of these notes come due, and more of the note holders say, hey, you know what, I got a non-recourse loan, you can have this thing back. Well, when the banking system starts to fail, Doomsday is here. That's why I think perhaps what's happening in Atlanta today is a signal of more of this to come. And Tower Place was 62% leased at the end of 2022, down from a whopping 87% in 2018 when the loan was originated. Among the 29-story building tenants is WeWork, the office sharing company that struggled financially. So again, you're going to see this over and over again. This is why I'm saying Doomsday is here. It's not just because we're seeing some issues in the residential real estate space. What I think is happening here is all of the tightening lending standards are starting to come to roost. And the problem is all of these commercial real estate loans, many of them variable rate, are coming due. They've got to be refinanced at higher interest rates with values at their current rate, when of course we know buildings are transacting at far lower values. The bag holder, it's not you, it's not me, it's the banks. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.